Fine. Good morning or afternoon, everyone, depending on where you're tuning in from today. My name is Carrie Richardson. I'm the founder of Managed Sales Pros, and I'll be the moderator for today's MSP Exits series. This is part one in a 5-part series. And today we're talking about when it's time to sell. We're going to give everyone a couple of minutes to get in, get seated, grab a cup of coffee. So we'll start our presentation in about 1 to 2 minutes. Thanks, and I can still see some people streaming in. So as I just mentioned, if you're just arriving now, we're waiting to give everyone a minute or so to get settled, and then we're going to begin with the content presentation today. This is part one in a 5-part series on how to sell your managed services company. All right, thanks everyone, and let's get started. We're going to start with a little bit of housekeeping today. You'll notice that you've got 3 different panels on the side. One says chat. This is a moderated chat panel. You can type in a question there. I'll receive the question, and then I can deliver it to the person that you'd like to ask the question to. So please indicate on your questions which of the panelists you'd like to answer the question. I'm going to hold the questions until the end of the presentation, just in case those questions get answered throughout the course of the content. The second tab you'll see is a section called polls. If you answer all of the poll questions today, you're eligible for one of the prizes that were generously donated by the people participating today. So Reuben Levinson from Washington Avenue Advisors has offered a complimentary business attractiveness and exit readiness assessment. Managed Sales Pros is offering a 500 contact call down complimentary for one winner today. And anyone today on the webinar live can schedule a 90-minute consultation with Ian Richardson from Richardson & Richardson Consulting, who is a certified Patterson StratOp guide. The disclaimer today, it's important to let you know that this is not legal advice and this is not financial advice. The opinions expressed here today are those of the attendees. They don't necessarily reflect the companies that they are representing. And you should always ask your own lawyer and your own CPA about any financial decisions you're going to make for your business. I'm going to introduce you to our presenters today. First, Christopher Vollmond-Carstens. Christopher joined Ntiva in 2020, and he's the Vice President of Corporate Development. He leads their M&A activity. He has some previous experience in this area. He's worked with Deloitte, GE, and Morgan Stanley. He has a bachelor's in economics from Williams College, and he has an MBA from the University of Virginia Darden School of Business. Thanks for joining us today, Chris. We really appreciate it.
Thanks, Carrie.
We're also joined today by Reuben Levinson. Reuben went to MSU. For a finance degree, and he started his first business in his 20s. He grew that business to become one of the largest home renovation businesses in Michigan before he sold it in his 30s. He is now an angel investor, advisor, and mentor to startups, and he founded Washington Avenue Advisors with his partners to work on investing, consulting, and venture capital. And he is also a pilot. Ian Richardson, I know this guy pretty well. He studied engineering at Lansing Community College and graduated from Northwood University with an undergrad in business. He grew his managed service provider, Doberman Technologies, to become a 7-figure MSP. He's a multiple MSP 501 and CRN 500 winner, I believe, every year for the last 7 years. And he also placed on the Inc. 5000. He sold his business in December of 2021. And he is a certified Patterson StratOp facilitator. So welcome, Reuben. You want to say hello to everybody?
Thank you, Carrie. Hello.
Thanks for joining us today. We appreciate you. Ian, say hello to everybody.
Hey, y'all. How y'all doing today? It'll be a riot.
I think we've got some great content today. So you'll also notice on the right-hand side, there are some handouts that have been provided. So for anybody that would like them, there are some links to the Washington Avenue Advisor site. There's a couple of calculators and different terminology glossaries that you can download from there. And there's also a document that we put up there for easy reference. So go ahead at your own convenience and download those. And you'll see that the first poll has popped up. And the question there is this your first business? So that's an important question because we're going to talk a little bit about serial entrepreneurs and how they approach business differently from others. First thing we're going to talk about today is why somebody would choose to sell their MSP now. I think, Ian, I'm going to direct that question at you since you did sell your MSP now rather than wait another 3 or 5 years. Tell us a little bit about why you decided to do that.
Yeah. Thanks, Carrie. So as Carrie mentioned, I'm a certified Patterson Stratop coach, and part of that certification process was to go through almost a business planning for my personal life. It's a product called Life Plan. It involved me going out to Colorado and spending a couple of days with a guy named Michael Chiarelli. Hey, Michael, if you're watching, love you, man. And as part of what dropped out of that, I really got some insight into what drove me, but also what was taking away from me. And a big part of what was taking away from me was running an IT business. I had lost the spark, lost the passion around technology. And it became readily apparent over the weeks and months after that, throughout the COVID pandemic, that this was more of a chore versus a joy. And so looking inward, I said, hey, if this is not what I'm meant to do, how can I get out? And when Carrie and I were going through a walk last summer, she said, hey, you're always such a big fan of no assumptions, no sacred cows, nothing's written in stone. Is you exiting from your MSP and having that be your retirement something that's written in stone, or is it more written on the beach in sand? And I think she looked back at me about a quarter mile later and said, hey, are you coming? And here I am standing in the middle of the road, dumbfounded. So it just, it resonated. And looking at the market, the time was right. Multiples were high. There was some opportunity. And so Reuben and I started having a conversation on, hey, I'm thinking I might want to sell my business. Walk me through what that looks like. And the rest is history, so to speak.
So that's why Ian chose to sell his MSP at this time. There are a lot of different reasons why an MSP might consider selling right now in 2022 rather than waiting an extra 3 to 5 years. Reuben, you want to tell us a little bit about some of the reasons people would choose to exit now?
Yeah, and I'm glad you started with Ian's story because I think that's just real. That's what happens. A lot of the business owners that we work with, that's the kind of questions we have to ask them. I'm a big believer that if you're not growing, you're dying in some ways, personally and in business. And so if you don't feel in your business that you have that spark, that you're inspired to grow it, you either got to find a way to reinvent yourself within your business, kind of the bloom where you're planted concept, or you've got to kind of uproot and rebloom somewhere else. And I think that's what Ian was going through. We see that a lot. I think that also it's good for people to start to understand about themselves if they are more of a serial entrepreneur versus a legacy style business owner. We work with both. They're very different though. Like serial entrepreneurs have to recognize that their personality, they need to do different things. They could do that within their business, but if they're not finding ways to reinvent and grow the business and in new and creative ways, if that's what they need, they're probably going to need to let someone else come in and do that and reinvent a bit. So those are a lot of the real life conversations we have. That's part of our exit readiness assessment we do. That's to help owners and entrepreneurs decide personally if it's time to exit. And then, of course, separately, you would look at business attractiveness and see if it's the right time or if the market considerations are right. The things that Ian talked about, those are all worthwhile to consider.
Now, Chris, Ntiva has been acquiring companies fairly aggressively since you joined them in 2020. What are some of the reasons that people are choosing to exit at this time in your experience?
Yeah, so there are a variety of reasons that sort of come into play when folks are considering a sale in the MSP space. A lot of times, as Ian and Reuben alluded to, it has to do with the point in your life where you have built a business over the last 10, 15, 20 odd years, and you're ready to sort of take a step back and sort of shift to a new phase of life. Perhaps you've got kids going off to college, or kids leaving college, or you're just ready to retire. So that's a big consideration that comes into play. I think the other thing to think about is how do you imagine the legacy that you would like to leave for your business. And you spent an innumerable amount of time and energy sort of building this institution that is a reference or a reflection of yourself, rather. And so you're wanting to potentially find a home for it that places it in good hands. And so wanting to think about what that means, not only for yourself personally, but the impact that this sort of decision may have on your employees as well as your clients. And then obviously the family considerations that come to bear. So I think all those things sort of weigh into the conversation. I think what's also important to be mindful of is what's happening around you. Ian alluded to it, and that there is a lot of activity happening in the MSP space currently as it relates to M&A. A lot of companies like Ntiva that are interested and active and looking to build via acquisition. Multiples for the right business can be quite attractive, and so that can be an additional consideration to think about as you sort of start that thought process for whether now is the right time for you. But I do think overall probably the most important consideration is to think about what it is that you most want to achieve out of a potential sale, and what it is that you don't want to achieve with a potential sale. I think that can be a guiding light and can help sort of firm up very crisp and clear thought processes and answers, so that you point yourself in the direction that you're most interested in going in consideration of a potential sale.
Reuben, do you have anything to add to that?
Yeah, one thing I think it's adding to that is I like to tell business owners, let's think of your business just like you would your home if you were preparing for sale. And if I were to do a show of hands, if I could see everyone, I'm sure that everybody on here, almost everybody would say they've bought or sold a home. And so if you think about that process you go through when you're selling your home, you get it all perfect, you fix it all up, you hire all those deferred maintenance projects that you've been waiting on, and you get it looking so good for the open house on Saturday. And then when you have to leave the house for all these people to come look at your house with the real estate agent, you're kind of looking at your house going, wow, I actually really like this place. It looks great now. And so with your business, same thing. Why not treat your business that way? Have it always looking ready for sale. You'll enjoy it more. The value will grow more. The first business I sold at 29 years old, I just remember going through the process of getting it ready for sale. And at the end of that process, when buyers started looking, I got emotional and didn't want to sell all of a sudden. So it can be a good thing for business owners.
Fantastic. Actually, I had a question come in that's appropriate for this point in the discussion, and nobody's answered it yet. Does anyone have an opinion on how the federal rate hike is going to affect the managed services M&A space?
I guess I can start there. What I'll say is that to this point, I haven't seen any material adverse impacts with respect to M&A activity. Things seem to be sort of very busy, but I think it's also a reflection that sort of the news coming across from the Fed is just so new, and there's a lot of unknown or uncertainty as far as how it'll exactly play out. What I do think, though, is that it doesn't necessarily change the situation that there are an innumerable number of parties out there looking to acquire. I don't foresee that going away in the near term. So while there may be an impact as it relates to the speed with which people are willing to to operate, or maybe it has a multiples impact, I still don't think it'll change the number of fish in the sea that are looking to partner up with MSPs.
So people that want to buy are going to continue to want to buy.
I think so. Unless something severely drastic occurs, I don't see things changing materially.
Now, Ian, when you decided to sell your business, one of the things that you and Reuben talked about is how you could take advantage of the liquidity that you'd have after selling your business. And as opposed to waiting for another 5 years and this being your final exit, you could use the proceeds from the sale of your business differently to get to that number. Reuben, can you walk us through a little bit on how an entrepreneur could sell their business now, take that equity, and then turn it into their retirement number?
Yeah, and that discussion always goes back to what we talked about in the beginning, like where they're at personally and the energy they feel about the business, the vision they've got at the time. And I think that also there's I call it the luck factor, LUC, liquidity, use, and control of your money. There's times that becomes more important in your life. And when you've got a vision for a new business or a new business concept or some sort of innovation, and you need capital for that, and you see potential there, that's the entrepreneur side that says, maybe it makes sense to sell my business now, have a liquidation event, have control of the equity versus have it all be on the balance sheet, turn it into liquid cash that we can do something new with. And you got to, Chris was saying earlier, you got to know, like, what age are you at? Where are your kids at? What are things with your kids? Is this the right time to start something new? Or do you wait? But I think Ian said it earlier too, that market conditions are a big part of that. And for him, it was kind of everything aligned, and he had something new to apply that capital and his energy to. So it was a perfect time.
Now, for those of us who, I started my business late. I was a minimum wage kid. I really didn't understand business or finance. When I met with Washington Avenue Advisors, you kind of talked me through 3 different types of saving. Can you tell us a little bit about that, just for like day one level people who might have just started their business and are trying to figure out how they're going to get from where they are to where they need to be?
Yeah, so I think you're referring to our buckets. We have a discussion with people about the 3 buckets of where your money can go. And obviously one of those could be in your business, building equity. And we talk about the tax impact on the 3 buckets. We spend a lot of time with people. There's the non-qualified investment bucket. This is where you can there's not a lot of rules. You can put as much as you want. It's liquid. We have to deal with some capital gains taxes along the way. Then you might have your qualified bucket, things you might do through your business, like a 401k, a simple or a SEP IRA. These are things we can take advantage of, some tax deferred dollars for the future. And then we have what we call our tax favored bucket. And that's where we can do things that we have to use some post-tax money today, but we can grow wealth in a tax-free manner there. And there's very limited ways to do that today, especially for higher income earners. We're limited there, but we have to get creative with the business owners, talking about even during their time running the business and post-sale, how do we allocate those into those buckets to make sure we don't have double and triple taxation. And that with the CPAs and attorneys, we spend a lot of time making sure they're doing a tax efficient allocation of their money and their business equity. And that comes into deal structure too, that Chris might get into.
Yeah, I think we're going to talk about that next. Thanks, Reuben. So this is a question for Chris. You're obviously acquiring a significant number of MSPs in the market right now. What should the MSPs that are looking to sell focus on before they go looking for a buyer? Like, what are the things that you're absolutely looking for before you're going to make an acquisition?
Yeah, so I think you can take this question in any number of directions to sort of look internally or externally to get yourself ready to sell. I think it harkens back to some of the comments that I had made earlier about trying to know what it is that you want to do, or what it is that you're trying to achieve with a potential sale versus what it is you may not be interested in or less interested in with a sale. Because I think that can help inform the direction that you're headed in. I think one of the elements to think about is, what is your intention post-sale? I like to think of it in kind of three buckets. One is you're ready to take the cash on hand and go sit on your boat immediately. The middle path is I'm interested in, for a relatively short period of time, call it 6 months, 12 months, even up to 18 or 24 months. I'm willing to commit to ensuring that my clients and my team have found the wonderful home with the company that acquired us, and then I'm ready to go sit on my boat. For others, it may be, look, I'm fairly early in my career. I'm ready to continue to do a lot more with perhaps a bigger sails at my back, bigger wind in support of me, and so I have a much longer time horizon out there. And based on the answer to even just this question can help inform who might be the right type of partner that you're looking to partner up with through the course of a transaction, because the motivations and intentions for potential acquirers can be very different. Some are interested only in acquiring companies where the owner is looking to make a quick exit. Others are much more strategic in nature and really wanting to partner up with the owner of the business for the proverbial "we're ready to take over the world" type scenario. And so it's really important to understand those sorts of considerations. And then based on kind of knowing what your preferred path would be, you'll get a sense of what those potential acquirers are most interested in with respect to the business profile, whether that's revenue structure, profitability, expenses in the business, client base, concentration, whatever it might be. And then you can kind of work through your checklist to focus in on making any changes, if needed, to make yourself best suitable for that potential acquirer. It's like what Reuben was saying earlier. If you're getting ready to sell your house, if you want to get top dollar, maybe you do have to do a bit of renovation on the kitchen, or refresh the paint in the bathroom, or fix up the HVAC system before you get yourself out there on the block. It's really about wanting to put your best foot forward for whichever path you're interested in taking, to make sure that you put yourself in the best position for success with the transaction and your intentions afterwards.
And Carrie, I'll just add on that. That's why it's helpful, not necessary all the time, but it's helpful if we can be talking with business owners 2-3 years in advance of their target exit date, because those are all the things you want to prepare and decide and prioritize what we're going to invest in over that time, whether it's their marketing and engagement plan, whether it's their attraction and retention plan with their top talent. Those are the things that we can do. Sometimes we have to do that stuff in 3 to 6 months. We have to get some things in shape because they have a reason they need to sell, or they've got an offer, or the market's hot. And so we'll do those things quickly, but those will really improve multiples and values quickly.
I've never really understood why people wait until they're selling their house to fix it up instead of making the changes that they want at the beginning. Like, you don't have to live with that hole in your kitchen ceiling for 10 years, then patch it so someone else can enjoy it. Patch the ceiling now, enjoy your home. You'll have very little work to do when it's time to sell.
I think if more business owners treated their business like that, they would actually enjoy their business more, while fixing it up and enjoying those improvements while they're still there too.
I agree with that. I think a lot of business owners don't invest heavily in their own education at the very beginning. Right? Like, I waited a long time to work with coaches and consultants or guides to help me figure out the things that I needed to know. And financial literacy would have gone a long way to probably letting me exit from my business significantly sooner and for a much better amount. We're going to talk about deal structures now. And one of the things that we were talking about when we were putting this webinar together is that there really is a deal for every buyer and seller out there. Like, for everyone from the one-man shop who just wants to take a vacation and they're kind of done and frustrated and they just don't want to be a business owner any longer, right on up to the, the business owner or owner operator who's removed from the day-to-day operations of the business, they're going to be significantly different transactions. They're going to attract significantly different types of buyers. And I know, Ian, do you want to talk a little bit about how you came to the conclusion that you would exit in the way that you did?
So when I decided to exit again, my timeline was short, so I wasn't doing the intentional items that Reuben had mentioned 2 to 3 years beforehand. However, I had started on a path through my involvement in a peer group of, hey, start focusing on the numbers, start running the business in a way that allows you to sell it so that if you need to sell it, you can. I wasn't all the way there. That was a 40-mile march that I was maybe 15 miles into. But I had done some of the intentional work around it. But my time from, hey, I want to sell to when I sold was 6 months. Very, very quick, very, very rapid. But the deal structure that I chose was informed by my buyer. So I chose to sell to someone who was involved in my business. So it was an internal sale to an employee of the business. That employee was my brother. So it was easy to have frank, open, vulnerable discussions because Mike and I had a semblance of trust. He had been there from the start. He knew the operations as well, if not better than me. He knew which clients were at risk. He knew all of it. All it was sitting down, looking at the books and saying, all right, here's where it is. Here's the folks who are probably likely to leave within 3 to 6 months of transaction. Here's the ones we know that have an end date on them, whether they're doing a private equity turn or they've been acquired, whatnot. So it was easy to back out revenue and contract dollars out of the figures into a financial forecast. We partnered with a business broker. Some of you may have seen him previously, Jay Cook, who helped us build a 3-year model based off of those figures. So which people came out, etc. And my primary consideration was I wanted to be done. So I didn't want an earn out. I didn't want to be involved with the company past a certain date. So we chose a deal structure with the SBA, a 7A loan, which requires me to be done within 12 months. So it set a firm time limit that both Mike and I had to honor of my involvement. And I'm mostly out of day-to-day operations as of today in June. We transacted December, 6 months in, I'm mostly out. There's about a 3-month transition window of some sales roles that I'm doing, and then I'll be done probably October 1, be completely out of that business.
All right, now we have a couple of questions that have come in around this. That probably will be answered throughout the slides, but I think this is an ideal time to post them. The first question had to do with staying with the person that purchases the business. Is it more advantageous to want to or to agree to stay with the company that's purchasing your MSP for a significant period of time? Like, how would that increase the value of the business?
I guess I can take that question. I think in making the determination on that with value consideration in mind, I think the better question is really about doing some soul searching for yourself to see what you think would really make you happy, continue to make you happy after a transaction. Because if you think about it, one day you're in the midst, you're running the business, you are making decisions, you are the top of the heap, and then the very next day, essentially, that dynamic changes. A, you hopefully have a large pile of cash in your pocket, but B, you're no longer the sole decision maker for your business, your employees, clients, etc. And so you need to kind of have a frank internal monologue to determine whether that's something that is sort of how you think about that situation. And many times, people may go in, to a potential sale feeling very optimistic about how they'll be able to handle a situation like that, or a change in situation like that. And sometimes, reality doesn't always meet expectation. And so that can make for, more challenged or difficult engagements and conversation down the road. So first, I'd say you really got to focus on having a clear sense of how you're going to feel after the transaction itself occurs. As for whether you staying or going would have a material impact on valuation, I'd say it depends. It depends on kind of what kind of special expertise or special sauce or capabilities, client contacts, etc., that you might be bringing to the table that are a new and differentiated capability that only you have and that would potentially be lost following your departure. I think the other thing to think about, and we haven't quite gotten to this topic, but I'll start to allude to it, is that your decision on whether to stay or go would have an impact or an influence on the transaction structure itself, as it relates to, are you going to be receiving only cash? Will there be an earnout involved? Are you considering rollover of equity in your business into the new organization? All those things will come into play and are influenced by the determination you make about your continued tenure with the business. I think there's a level of attraction to a buyer if you are willing to roll over a meaningful amount of equity, and by that I mean 15, 20 to 30% of your business, because that shows a commitment to the new business over a long period of time. So that can be a level of attraction for a buyer. But ultimately, it comes down to what it is you feel is going to make you the most happy, and there is an understanding that sometimes your feeling may change after 6 months or 12 months, 18 months, whatever it might be. And so it's really important to have that open and frank conversation with the CEO of the business you're joining or kind of other key stakeholders, so that if your mind is starting to change, that a smooth transition effort is put in place, so it leaves everyone with a positive taste in their mouth at the end of it.
So looking at different sizes of companies, there's been a couple of questions about valuations, multiples, and obviously those are very, very unique to each transaction. So you can't really say, hey, well, we buy every MSP at a 3-time annual revenue multiple or a 3-time EBITDA multiple. Or I want to go on to the next slide. Thanks. We're going to talk a little bit about deal process now and what people are looking for, what they're going to have to provide. And I think the one theme that I'm hearing throughout this between Reuben, Ian, and Chris is that the transaction is going to be highly dependent on how motivated the seller is and what the buyer wants. So there isn't really a magic formula. Somebody asked if there was a quick and easy formula that you could use to figure out what your valuation was. Reuben, is there a quick and easy formula valuation?
I'd say typically in the MSP space, and Ian, you can help me with how this worked out with your deal. But typically, I always tell people, if you've got an average business model, we're going to be able to get around 2 times EBITDA. That's pretty low. I mean, you could command up to 10 times, maybe even more, depending on the size of the MSP. But Ian, where did that? I don't remember if there was a range or how that fell for you. But when we were looking at multiples, where did that land?
Yeah, I mean, there's some well-published documentation off of Paul Dippel's work that's everywhere around the SLI numbers. In practicality, the 2 things I found was multiples and whatever is completely irrelevant. What your business will be valued at is what someone's willing to pay. So there's a piece of advice that Paul gave me way early on in my days that he said, hey, look, a deal will happen when everyone is mutually unhappy. But another thing that I found to be true through mine is that a deal will also happen when one or the other party is sincerely motivated to make sure it happens. So when you run into a roadblock, if you've got a motivated seller like I was, I ran into multiple roadblocks, a ton of them from the financial institution. And I said, well, I'm going to drag this across the finish line with my teeth because I want to be out. So if you're a motivated buyer, a motivated seller, then you can make the deal happen. The other thing on the formula that I could say, and I got this from a guy named John Nyland, who is a senior vice president at IBM. And this is based off of IBM's experience in the services industry for 50 years. He said, look, at a minimum, a quick and dirty way is that if you're a services-based business, meaning more than 50% of your revenue comes from services, do a 1x multiple of your service revenue, you're going to get at least that. So if you're a $2 million business, you got $1.5 million in services revenue, you're going to get around 1.5 at a minimum. Now, that's not a hard and fast rule. Again, your mileage may vary. This is just from John to me. That's a thing that IBM found over 50 years of buying and selling services-based businesses, is that you'll get at least that. So hopefully that'll kind of help out with that, is that you can at least count on that.
That's a good starting point. And then there's all the other levers that you can pull on to increase multiple. Are you willing as the seller to stay on for that role, like Chris was talking about? Are you willing to take a seller note? There's all these different things you can do to try to improve value, improve the deal.
Yeah,
Now,
Chris, maybe you could talk about deal structure a bit. What are some of the things that Ntiva's found to help someone get to a number?
Yeah, so what I would say to that is probably sort of two main considerations in mind. I know we're talking about sort of the financial element of it. So the EBITDA of a business, that's the sort of the adjusted EBITDA of a business, kind of after you've removed owner expenses and the like, so you kind of see what a true profitability of your business would be as a standalone entity. That number is sort of the key driver, from our perspective and many others in the business, to apply a multiple on. What I would also say is that as a general rule of thumb, as your EBITDA increases, it also opens up the opportunity for an increased multiple on your business. So, a business with a 500K in EBITDA is going to be valued, generally speaking, lower than a business that is a $2 million EBITDA business. But there are a host of other factors that are involved in that. As an example, you're looking at, what percentage of your revenue profile derives from recurring revenue contracts. Are those contracts annual or multi-year? Do they auto renew? What is the gross margin of your business? Is your revenue increasing at a steady clip or an accelerated rate? How is your customer concentration? Are you beholden to a single client or two that drives the vast majority of your revenue? And are those relationships or those clients, is that solely you? So if you leave, does that immediately put those largest clients and thus your revenue and profitability at significant risk? That can be a detriment to the potential EBITDA and valuation that you may be able to enjoy. So I guess the simple answer is that there are some directional guidelines, as Reuben and Ian had mentioned, but everything kind of falls into the soup. I think there's one other one that I'd mention is just the kind of operational maturity of the business. Again, this is a metric or an attribute that Paul Dipple from SLI has worked on and developed, and that's just to help kind of understand just how mature your business is from a process procedure perspective. As with a higher operational maturity level or OML, that can also bring about higher opportunity of a larger multiple. But again, it's all a bit of the soup that comes into play. But I do think the point that Ian made about a motivated seller or a motivated buyer, that will really help get things across the line in the light of potential difficulties along the way through through a process.
So we had a question come in, and Nancy would like to know, are the multiples usually taken over a 3-year average or a 5-year average?
My experience would be 3 on that.
Sorry, go ahead, Reuben.
I was saying my experience has been 3 lately on those. We're in several deals right now, and 3-year average is what the evaluators that we work with are using.
Yeah, so we look at it a little bit differently. We're looking at what your what your EBITDA is kind of over a last 12 months basis, and typically applied a multiple against that. It's usually not done in isolation. It's done in an understanding or reflection of what profitability looks like in prior periods and the trend over time. If EBITDA is on a steady clip of increasing, that is advantageous. If you are flat to down, that can have an adverse impact on the multiple that a buyer would be willing to pay.
So I can say 2 things. When I was going through the process of mine, I had a private equity backed MSP look at procuring Doberman, and they did exactly as CVC mentioned. They did a 12-month, and we had to go through a total of 3 business evaluations to get Doberman sold. 1 from my end, 1 from the buyer's end, and 1 from the finance institution's end, and all of them looked at 3 years. So it kind of depends. If you're going through a formal valuation, might be more on the 3-year end, but my experience with PE was 12 months as well.
Also worth noting in all of these situations with the recent effects of pandemic, economic shutdowns, and all kinds of crazy things, there's a lot of understanding. I have seen people looking back 5 years now to try to surround that unusual period that we've all had.
I have a couple of other questions that have come in. And the first one, sorry, I posted it. Somebody would like you to elaborate on the rollover of equity into a buyer's business. What would that look like? How would they negotiate it?
I might start on that and let Chris finish, because we're actually in the middle of one of those right now. We're the buyers on this one. Seller is asking for some carried interest in the company. I get to a point, I think it almost stopped the whole deal, and it became really important. I had to sit down with the seller and understand what she was looking for in carried interest, because my understanding as we went into these negotiations was that she really wanted to do a 1-year transition with us as the seller, and then she wanted to be out. And so typically we won't give a seller carried interest in the company or carried equity for a second. People call it a second bite of the apple. They sell now, they get to sell again with us if we sell the business, say 5 years down the road. But we typically won't do that unless they're going to carry a meaningful role for at least 3 to 5 more years. In this case, she clearly wanted to be done after 1 year. So we were able to work through that, flip that back to some consulting income, and also gave her a way to make more money on the deal if she brought more to new accounts during her 1-year transition. We even gave an extra year where we would pay a nice fee or commission on any new account. So she just wanted ways to make more money on the deal. It was her baby and it was her business she built for 20 plus years. We just couldn't do that in the carried interest unless she would stay on a little longer. Chris, you might add to that.
I think that the perspective and the conversation that you had with the seller is exactly the same one that we would have in contemplating a rollover equity for a transaction. It really is about sort of what is the longer term intentions for the seller. If we are mutually able to carve out a specific role that really suits the advantages and capabilities of that individual, and it can have a high impact on the business, whether that's growing or building new capabilities, building client base, kind of other kind of special offering, and their time horizon is lengthy. then we are much more amenable to rollover equity, as it really does align the incentives of both buyer and seller through the course of the transaction. I'm not sure if that's perfectly answered the question that was raised, Carrie.
Carrie, I have one other good
happy
example.
to elaborate further.
Okay.
One other good example in that we just worked with another MSP seller recently, locally here. Ian, I think you know them, and they were two partners and a very well-established company. And so these two partners in a sale to a larger firm that was rolling them up, they got a good multiple and everything. And one of the sellers wanted to be done, and one of the sellers was willing to stay on. And so we worked with them through this, and we were able to help them, at least on the seller. We were representing the sellers here, and we were able to help the two sellers with very different goals work with their buyer to get the one seller out. And the one seller wanted to stay on for 3 to 5 years, and he was able to keep a piece of the carried interest. And I've talked to him recently. He is completely rejuvenated and excited about his new role. He doesn't have to deal with the old headaches that he didn't like. The new company took all that. He gets to do what he loves. He's a relationship guy. He's out front working with the big accounts, and he gets to still stay involved with his team that he built and not have to leave them there. And he gets to be part of that transition for 3 to 5 years, and he gets a significant piece of the carried interest. I think it was 15% or so. So he knows that this company that bought them is going to roll this up and probably sell again in 3 to 5 years, and he's going to make another big hit on that sale. It's a great deal for the seller.
All right, I have a few more questions, but I want to hold them until the end and start talking about deal process. So thank you, everybody. And thanks for everyone that's sending your questions. Please keep sending them. And remember, if we don't get to them within the hour allotted, we'll make sure that somebody does send you an answer for them. But what I'd like to talk about now is the actual deals themselves. How long should it take to go from, hey, I'm interested in buying your business, to a closed deal on average? Best case scenario, worst case scenario.
Best case, probably Ian's deal, 6 months.
I sold mine in 3 days, by the way.
I remember you telling me that. I was like, what? That doesn't happen. You must have had some secrets there to share. But
motivated buyer and seller.
Good timing. I will say, and we have joked about this internally here, almost every business owner we've worked with during the pandemic times has not had they've all been selling quick. There's just so much M&A activity right now. It's unusual and it's not sustainable, I don't think. But lately it's been fast. We've been seeing things sell in 6 months to a year from their idea of selling to done. And that's just crazy. Usually you would hear, let's give it 2 to 3 years for a good, healthy exit for the seller.
Okay.
Yeah, I mean, what I would say is that the gestation period of a transaction, of a deal, can be very quick to quite elongated, and it really depends on whether the company and the seller has put themselves in the position that they would like to be in for a transaction. Now, whether that's they want to hit a certain size hurdle, or contract renewals for their largest customers. Or they just, they've got some other event that they need to get through before they get to sort of a sale process. But kind of once you are committed to the effort, if you're working with a sophisticated buyer, they have the capabilities to move as quickly as they're getting the information they need to make their informed decision, and B, how quickly all the documentation can be put together to make it official. So that can go as quickly as 30 to 45 days, or the average that I'm seeing is 60 to 90 days from the point in which a letter of intent is executed, and that's a good time range to sort of maintain the momentum up to that point and through to close without getting bogged down, because at the end of the day, both buyer and seller are still, running and operating their respective businesses, and M&A can be a distracting event. And so the ability to move through it efficiently is highly valued by both buyer and seller.
So we have a question about contracts, contract length, and contract types, and how they affect the value of the business. Is there any value placed on the book of business that is over and above the annual recurring revenue of the business? So if somebody had 3-year government contracts, for example, would that be a higher value business than a company that was signing 1-year contracts?
I would say typically yes, just because the certainty of that revenue stream extends out for a much longer period of time, and the ability for a more natural handoff in the client relationship is not under as much time pressure with a longer contract duration. So I'd say that generally speaking, the longer term contract is going to have more value attributed to it in the overall consideration. Yeah.
And then one of the things that we talked about when we were prepping for the webinar was size of contracts. So if you have clients that are heavily loaded in one industry, or clients that make up a very aggressive percentage of your book will be valued differently. Can you talk us through that a little bit?
Sure. So, it could be an advantage if you're a business that focuses on a particular industry vertical with respect to the composition of your customer base, particularly as it relates to regulated industries, whether it's healthcare, finance, government. If you've got a niche and an expertise in being able to serve clients in those areas, that can be valuable to a prospective buyer, either looking to build their own capabilities or expand that which they already have. There's also something to be said for relatively varied diversification amongst your client base, such that if a particular area or sector is adversely hit, it's not going to tank the entire business of yours. I think the related point to that is that you kind of want to hit that, I guess it's like a Goldilocks type sweet spot with respect to client concentration. There is some concern if you have 1 or 2 anchor clients that make up 30, 40, 50, 60% or more of your client base or your revenue. That can be somewhat concerning, particularly if it's under a shorter contract duration, or you as the seller are the primary relationship with that client. That can be put at risk through a transaction. Same could be said on the opposite end, that if you are an MSP that has that's still small but has hundreds of clients, and the amount of revenue that you're generating from each of those clients is quite low, that's a huge administrative burden to be dealing with. And so you go too far in the other direction, that's probably not as advantageous. I think you really want to try to set like a minimum threshold by which the revenue from your clients is at, and kind of try to stick to that, so that that with clients that you have on board, that they're kind of at a threshold of meaningfulness to you and your overall performance, without being beholden to 1, 2, or 10 clients to kind of drive the overall profitability of your business. So again, it's a bit of a needle to thread, but I think as long as you're sort of towing toward the middle as best you can, that can be an advantage for you.
All right, so we're getting close to the top of the hour. We got about 7 minutes left. I'd like to talk a little bit about what goes into an NDA. What is that when you're signing an NDA? What are you saying to the person that is buying your business, or who is interested in buying your business?
Sure, I can start with this one. For an NDA, I think for an LOI, are you saying NDA or
let's
LOI?
start with the NDA. So the first document you're going to get at the very beginning is going to be an NDA, right? The seller is going to send you one, or the buyer, you're going to sign something that says what?
Yeah. So the NDA is really about protecting the sharing of information between the two parties, such that you are protecting yourself from wanton sharing of information that's sensitive and personal about performance of your business. So that's really to help encourage the open flow of information and conversation between the two sides, so you can speak openly and frankly, and really allow the buyer to get a good knowledge of your business without having to worry that they're only getting a small piece of the puzzle. As it relates to the non-solicit side of things, that's also an important element of the NDA. you want to be able to protect both yourself and the buyer wants to protect themselves, such that with the information that you're learning, through this discovery process, that you're not using it to A, poach clients, B, poach employees, or do anything untoward to adversely affect the performance of the other business should a transaction not occur. And typically the timeline for that is, anywhere from, a year to 2 or longer, depending on what both sides mutually agree to. But that's just sort of to protect the continuing performance of each business.
Excellent.
And then last piece, I guess the most meaningful one amongst the three, is the letter of intent. It is typically a non-binding agreement that is agreed to between buyer and seller, which states and stipulates the key terms and considerations for the transaction itself. So sometimes it can be as simple as, this is the value we want to pay, and this is how it's going to be structured, composed of cash, rollover, earnout. This is what the earnout means. It will also typically include attributes like, what is the escrow that is going to be held back from the cash consideration as a protection for net working capital reconciliation, anything having to do with the terms and conditions, reps and warranties of the transaction itself. In many other LOIs, it will help to stipulate out what will be the go-forward plans for the owner or for the seller. Is there a role? What is their salary? Who might report to? Are there other key employees that need to be factored into the overall purchase, the overall acquisition documents in the form of employment agreements for those employees? What will that constitute? Then it also, another key point of the letter of intent is I'm blanking on the phrase right now, but essentially says that you are not, during the term of the letter of intent, you are not going to talk to any other prospective buyers about the transaction or about selling yourself. You're going to focus with just this one buyer, with the hope that before the end of this time period, that you will conclude the transaction.
Is it legally binding?
It is typically not legally binding, but it's used as a means of stating your very strong intent of what you want to do. I'll say, for an example, with Ntiva, we take the letters of intent very, very seriously and try to work out all the items that I previously discussed, such that we have a very high conversion rate of LOI to executing a closed transaction. I think out of the, we've done nearly, 15 acquisitions over the life of our business. There's been, 15 letters of intent. Maybe one didn't end up in a closed transaction because the seller sort of misrepresented some information. But we take that sort of thing very, very seriously. That's sort of a mark of our commitment in going forward with the transaction. But it's also important during your own diligence efforts to understand with prospective buyers just how seriously or not they take what is stated in a letter of intent, just so you kind of manage your expectations accordingly.
So I think we covered off a lot of this, and we're coming up to the top of the hour. But Reuben, is there anything that we haven't covered on making your business more attractive to a buyer? So I'm not going to sell my business today, but in 3 years, I'd like to be done with this. What should I be doing right now to make sure that I'm going to get a high valuation 3 years from now?
Yeah, it's that open house concept we talked about at the beginning, getting it ready for sale, right? And there's a lot of things you can do. I would say, that is, I know we're doing a giveaway today of our business attractiveness assessment, exit readiness assessment. And that's what that's meant for, is to do a quick assessment on where the gaps are. So for every owner, it may be different, but, there may be some primary things. It's brand and brand recognition in their space. It's, if you could even get into things like client concentration. If the client concentration isn't in that sweet spot that Chris mentioned right now, we can work on that. If we have the time, we can work on that. A lot of creative things you can do. And I would also look at the team and the talent and the leadership of the company. That's probably for us as buyers, one of the most important things we look at is the continuity of the company. When that seller leaves, I want to know that I've got leadership in there that is committed. Why are they committed? Do you have any sort of deferred compensation plans or bonus plans or even potential equity incentives for the top leadership? We typically will do that. If they haven't already done it, as a buyer, we'll come in and add equity incentives because those leaders and the staff there are so important to us. Those are a few things. There's a lot more.
And there were a bunch of questions that came in that we're not going to be able to answer and then honor everybody's time commitment today. But we will make sure that every question gets answered. There was one that came in that I don't mind going a minute over to hear the answer to, and that is, we had great numbers except for 2020 when COVID hit. How does COVID, do people take the COVID numbers into consideration when looking at evaluation?
We are right now on a deal. We are willing to definitely take that into consideration as the buyer. I can't speak for all buyers or banks involved, but yes.
Yeah, I would say yes. I think it speaks to what Reuben said earlier around looking at a longer time horizon of performance on the business to kind of get a pre-pandemic view of how the business looked like. And then I'd also say, we're 18 months post 2020 at this stage. It'll be helpful to see kind of what the recovery of your business looks like from 21 into 22 after the quote worst impacts of 2020. So we're trying to look at all things holistically without adversely dinging you just for sort of a once in a lifetime hopefully event like 2020.
All right,
Carrie, if you have another minute, I'd just give you an interesting observation on your polls. I was enjoying the polls here, and you've got a really a dominant amount of what I would call entrepreneurs here who claim this is not their first and won't be their last business. So that's great to see. And then it's interesting that although 50% of the group is confident they'll hit their number they want for retirement, there's about 30% of the group who don't know their EBITDA numbers. So there's maybe some disconnect there, or maybe they're just not.
Maybe they just don't want to answer.
Yeah.
That was one of those questions where I thought I'm going to give everyone an out on that one. It's kind of a personal question. If they don't want to answer it publicly, I get it. So we are at the top of the hour for our time today, everyone. I want to thank both Reuben and Chris for volunteering their time today. I learned a lot, and I'm sure everybody else on the webinar did as well. This will be published on demand, and everybody's contact information is listed on the previous slides. If you'd like to get in touch with anyone that presented today, you can find them at ntiva.com, waadvisors.com, or r&r.consulting. Appreciate everybody that gave up an hour of their day today to spend it with us, and like to respect that time and let you get back to your day. So thank you, everybody. We appreciate you. The next in this series will be on the third Thursday in July. Same bat time, same bat channel. So there is a link when you leave the webinar. It'll take you right to the series registration. We hope to see you at the next one. Thanks, everybody.
Thank you.
Bye.
Thanks, everyone.